Hi, this is Ken Landau, and welcome to Law You Should Know. Today we'll be talking about long-term care insurance and some of the new ways it's used to provide benefits to many of our listeners. Our guest is Natalie Karp, and she is the head of Karp Loshak Long-Term Care Insurance Solutions. She and her company have been around a long time, and she is an expert about all facets of long-term care insurance. Natalie, welcome back to Law You Should Know.
Thank you, Ken. Thank you for having us
So
today.
before we talk about any of the details, just quickly explain what long-term care insurance is.
Long-term care insurance is picks up where your medical insurance leaves off. So it's a separate pool of money that allows an individual to provide for hands-on or custodial care. So this is typically care that's received once somebody leaves a rehab or a hospital and still needs help with activities of daily living, meaning eating, bathing, dressing, transferring, toileting, or continence, or is cognitively impaired and needs either hands-on or standby assistance.
And this is, rather than paying the medical benefit, this will actually pay a sum of money that you can use for those services.
This pays a caregiver, or this pays specifically for caregiving. So in the home, caregivers can provide care. If you think about 8 hours a day or 20 hours a day or 24 hours a day times $20 to $30 an hour, it adds up very quickly.
So, go ahead.
Or this can be used in the community, daycare programs. It can be used at assisted livings. It could be used in community care retirement centers. And so the paradigm is really staying at home and aging in place. And that's what we see now that consumers and certainly boomers demand. They want to age at home and in place.
And gracefully.
And gracefully and independently and with dignity and be part of the community. What long-term care insurance is not, it is not nursing home care insurance. By all means, this money can be used as needed, but the consumer is in control of where they want to use those funds, who they want care provided by, and how they want care provided.
And so just what is the difference between this and Medicaid?
Medicaid is a government resource, and it's the government saying
It's the government saying how much? Or
it's the government providing those who are impoverished with the ability to have something.
But the government is choosing where and how.
The government is choosing where services are provided. Typically, it's a nursing home model, although managed Medicaid is certainly delivered in the home now. We are seeing many, many changes in the Medicaid landscape. So what Medicaid will look like in 10 years, 20 years, 30 years, when your 50-year-old may be thinking about Medicaid, will be certainly a vastly different model if it's here at all.
And some people who think about spending down their assets to be entitled to Medicaid, this provides a different and better option.
Absolutely. If clients want control, if clients want choice, if clients would like to say, I want to be in a community care retirement center, I want to have 24/7 home, they're on a private pool of money with long-term care insurance, they're able to do that. Medicaid is really determined from the government. There is no CCRC or community retirement plan. They may not deem you necessary for 24 hours of care, and certainly there's very little, if no, assisted living available.
And even if you're in the long-term care, let's say, facility, this is going to pay for the services you need to stay there.
Private long-term care insurance benefits will pay for care wherever the consumer wants to purchase that care.
Okay. And what are there different benefit levels?
Benefit levels range depending on the state, but an average in New York would be $100 to $500 a day. So somebody could buy a benefit as low as $3,000 a month, or they can buy up to $15,000 a month. And obviously, the higher the benefit design, the greater the premium will be.
And also, how is it triggered?
Long-term care insurance has federally mandated triggers, meaning that in 1996, this was written into the HIPAA legislation. So the mandates for benefits are the same regardless of the carrier and regardless of the plan design. That means when you have 2 out of the 6 activities of daily living, so somebody needs help with bathing, dressing, transferring, toileting, or continence. So typically we see bathing, dressing, or transferring as a sort of the first start, or the individual needs help because they're cognitively unwell. They need either standby or hands-on assistance.
And let's say you trigger this because of a stroke or an accident, but then you recover. So are you able to use it for a couple of months or years till you recover?
Absolutely.
And then go back to working, and the benefits would kick in down the road if needed?
Yes. So the pool of money is available at the moment the contract is put in place. And when you need claim, you're spending down those benefit dollars. Now, a year later, you may be recovered and stable, no longer need benefits. You stop the benefits, and whatever is remaining in that pool will be available for you at a future time. There's no time limit on the pool of dollars.
And what about qualifying for it? When should people think about it, or children think about it for their parent or relatives, etc.?
That's sort of the magic question. Everybody wants to know when's the perfect time. So we say if there's family history, if there's Alzheimer's, Parkinson's, if there's any family history, it really should be on your top list of your top planning. So do it now. And for anybody else who's starting to think about financial planning, retirement planning for longevity, it's an important part to anchor in everything else you've done. So we say younger and healthier because in the absence of the crystal ball, younger and healthier is going to lock in your age and typically lock in your health.
Are there different levels of premium or different levels of benefits for different health scenarios?
There's different levels of underwriting. So typically we see standard underwriting. There's a level above that, preferred, and there's a level below that when we have some complicated medical conditions. But because we have so little room, it's really generally standard with an option to be up and an option to be, one level down. It's not an easy insurance to qualify for. It's not like life insurance where we've got a table of 40. So that's, again, the urgency to do planning when somebody is typically younger and healthier, an absence of health conditions, and also we see they may be married. So there's spousal discounts, there's good health discounts, and so when they're younger, they can really be saving a lot of premium.
Can they do it as part of a group plan if a business or law firm wanted to provide that benefit, let's say, to their partners?
They can. There's still a couple of group plans available, or we look at things on a case-by-case basis for carriers.
And this is where partly your expertise comes in, knowing who writes what risks, helping people qualify, and shopping for the best plan.
Absolutely. What's really important for consumers is that they get educated and look at everything comprehensively. So we're navigating an age, a health, medical conditions, medications, state residents, and looking at every single carrier in the space. And what that means is we're going to navigate traditional long-term care, asset-based solutions, hybrid, linked benefits, etc. Because you really want to look at apples to apples, but across a very wide breadth, so you can see where is the value proposition given the health profile, given the age, etc.
And we'll discuss those options and those concepts a little bit more later in the program. So, who is the you mentioned people should think about it earlier rather than later, and before they have a health problem rather than after. But after may not be impossible. It depends on the nature of the problem.
So, absolutely. We're seeing younger and younger candidates come to us. So I would say we've seen more 30s this summer than ever. So typically, we would say in the 40s, but we're seeing 30-year-olds, and we're up to 83. So the range really is typically 35 to 79 is probably the sweet spot. And within that category, I would say people who are well advised, are taking care of this planning, or people who've had a family experience, because they understand not just the financial ramifications that become super complicated and compromise lifestyle and well-being, but also the emotional consequences. We've got blended families, we've got siblings, and so my mother used to say, one mother can take care of 5 children, but 5 children cannot take care of one mother. It still has application, and so kids don't always agree on what we're going to do and what the best solution is. But when you're talking about having a private pool of money off the table and not touching resources that people have worked so hard for, and again, they can keep those resources for legacy and lifestyle, it becomes an easier process to manage.
And this is going to be a resource for them, so they don't have to take the money out of their pocket or out of their assets or out of their savings.
Absolutely. So when you have a separate pool of money with long-term care insurance, you're not disrupting everything you've worked so hard to build. So we have clients who have their haves, we have mores, and we have most. So these people have done really well, to which we say, bravo, let your money grow. Continue to do what you're doing. Make money on your investment accounts. Continue to give philanthropically. Do all the things you want to do to enjoy your lifestyle, your income stream. This is a separate pool of money that allows everything to work as planned. And so we're seeing more and more long-term care insurance be used as an estate planning tool. The Wall Street Journal ran a fantastic article June 7th, 2018, entitled Long-Term Care Insurance Isn't Dead, It's Now an Estate Planning Tool. So we're seeing the affluent and the high net worth client coming in because, to your point, self-insuring doesn't make economic sense. If you're self-insuring and you take out your dollars worth of private money, you have to pay taxes on that money, and you have an opportunity cost because it's no longer generating the income from the asset base that you've disrupted.
And you could still leave that to your heirs, or still contribute to charities, or still, take trips, I guess, if you can.
Absolutely. So you can maintain your lifestyle, your second house, your art, your children, your tuitions, and all the promises that you felt important for your family, and continue to maintain that while putting in a separate pool of money, because that separate private pool of money is not going to disrupt everything.
And as you mentioned before, this preserves your financial well-being.
Absolutely. So
as well as gives you the peace of mind.
Right. The financial well-being is the easy part. That's the part that's on paper. And what people don't often recognize until they're in it is that outside of the financial well-being is a huge emotional consequence, because kids have to get along, people have to agree how much to spend, where to spend it, and it's not sometimes so easy to get kids who are from, adult children, blended families, living in different cities, to start managing, which is what is a very financially and emotionally draining process.
Okay, we're going to take a short break now. When we return, we'll continue our discussion of long-term care insurance and its many options and many forms. We're talking with Natalie Karp, who, as you've heard, is an expert in picking and choosing and qualifying for long-term care insurance. She's the head of long-term care insurance solutions in Roslyn, and they handle clients all over the island of New York City and lecture on these issues to accountants, lawyers, and financial planners. You're listening to Law You Should Know, the voice of Nest Community College, at 90.3 WHPC, and over the internet at nccradio.org. We'll be back in a moment.
This portion of programming on WHPC is brought to you on behalf of the Nassau County Bar Association, who wants you to know about ADR, Alternate Dispute Resolution, which can help you avoid costly, lengthy, and uncertain litigation in court. By resolving disputes through mediation or arbitration, it gives you control over who decides your case. A mediator helps all parties to reach an agreement they can live with, or an arbitrator selected by the parties hears and decides the case. Your attorney can still represent you, but you control who decides your case. ADR is faster and less stressful